/CH/N. Good evening, and welcome to Market Focus. Today, global risk assets experienced an extremely divergent trading session. Our assessment is that the probability of this being a bull trap reversal stands at a high 65%. The market appeared to be catalyzed by a single geopolitical positive, exhibiting what we consider an unhealthy risk appetite. Let's quickly review today's key market figures. The Nasdaq closed up 1.62% at 24,653.52. The S&P 500 gained 1.03%, finishing at 7,137.12. The Dow Jones, however, lagged somewhat, rising only 0.68% to 49,482.80. The VIX Volatility Index saw a slight decline of 2.92% to 18.92, yet notably, the 10-year U.S. Treasury yield moved in the opposite direction, climbing 0.05% to 4.29%. The U.S. Dollar Index, DXY, also strengthened, up 0.21% to 98.61. Offshore yuan, USD/CNH, traded at 6.82339. The cryptocurrency market was a strong performer, with Bitcoin surging 3.93% to 78,597.29. Crude oil also saw significant gains, with WTI up 3.57% to $92.44 per barrel. Spot gold, conversely, dipped 0.61% to $4,747.90. Looking at sector performance, today's strongest sectors were energy, technology stocks, especially AI and semiconductors, and industrials. The weakest sectors included real estate, utilities, and materials, clearly indicating a structural divergence in capital flows. Let's trace the global market's journey today. Asian markets initially set a cautious tone. A modest rise in the Nikkei was offset by a significant decline in the Hang Seng Index, particularly Hong Kong tech stocks, which failed to sustain the previous day's U.S. optimism. Instead, they showed an early turning point, reflecting international capital's conservative pricing of Chinese assets and continued vigilance towards global macro pressures. European markets then acted as a drag on sentiment. Futures broadly fell in early trading, directly reacting to higher-than-expected UK inflation data. European markets absorbed no optimism whatsoever, amplifying risk aversion and setting the stage for the dollar's subsequent strength. The US market, however, was the sole leader and emotional pivot point globally today. It completely disregarded the caution from Asia and the pessimism from Europe, launching an independent short squeeze after the open, fueled by news of geopolitical de-escalation. Crucially, the rally was almost exclusively confined to tech growth stocks, represented by the Nasdaq. The Dow and S&P 500 saw comparatively smaller gains, and sector differentiation was extreme. This suggests that even within the U.S. market, there wasn't broad strength, but rather a rally driven by the exceptional performance of a few sectors. The market chose to ignore several critical bearish signals today, making the strength of this rally questionable. Firstly, it overlooked the pressure from the 10-year U.S. Treasury yield climbing to 4.29%, which should typically be a negative for high-valuation tech stocks. Secondly, the robust performance of the U.S. dollar index, DXY, breaking above 98.60, which usually drains global market liquidity, was also disregarded. Finally, the inflationary implications of Brent crude oil prices touching $101 were put aside. The market opted to price in only the single geopolitical positive of a reported U.S.-Iran ceasefire, temporarily shelving all the macroeconomic bad news. We openly acknowledge that our call yesterday, predicting the market would enter a risk-off mode with a 60% probability of decline, was completely disproven by today's Nasdaq reaching new all-time highs. The core error lay in misjudging the market's pricing priorities. We believed the market would continue to trade around the stagflation macro theme, focusing on high inflation and interest rate concerns. However, after a series of declines, the market's pricing priority briefly shifted to the elimination of geopolitical risk premium. When the most pressing war risk subsided, traders chose to cover short positions and chase an oversold bounce, deferring macro issues to another day. This is a classic case of short-term trading behavior overriding long-term macroeconomic logic. Indeed, a new structural signal emerged today: extreme divergence. This refers to the vast discrepancy between tech growth stocks and defensive value stocks, and between risk assets like equities and safe haven signals like the dollar and rising bond yields. This is not a sustainable, healthy structure. It indicates deep contradictions and disagreements within the market. Some capital is gambling on tech, while other funds are hedging inflation and interest rate risks by going long on the dollar and selling bonds. Such a structure often foreshadows significant market volatility ahead. Looking ahead to tomorrow, we maintain a cautious stance. Asian markets will likely open facing the challenge of digesting the US market's divergent rally. We anticipate cautious performance from the Nikkei and Kospi. The Hong Kong market, especially its tech sector, is likely to open lower under the dual pressure of a strong US dollar and high interest rates. A-shares might show relative resilience due to internal policy expectations, but overall upside potential will be limited. We have several specific predictions for you to consider. The Hang Seng Tech Index is expected to underperform the CSI 300 tomorrow, with a 70% probability. The upside momentum for the Nasdaq 100 Index, QQQ, will significantly weaken or see a pullback, with a 65% probability. The US Dollar Index, DXY, is expected to remain above 98.50, with a 75% probability. Bitcoin will face strong resistance at the $80,000 psychological level, with a 70% probability of its upward movement being capped. Finally, the ratio between QQQ and XLU, representing tech stocks versus utilities, is predicted to peak and decline, with a 65% probability. In conclusion, given the pronounced divergence in the trinity of equity, bond, and currency markets, we advise investors to reduce their bullish bets on a unilateral stock market rally. More reliable trading opportunities.